In this short video, I want to look at 3 tips for income investors. Whilst building capital over the long term is important, the reality is that income is ultimately what we draw down to live off, and income investing principles apply just as they do to people trying to build wealth in the form of capital gains. So let's take a look at these. A short checklist. Number 1, diversify. Avoid single stock disaster risk, as I call it. Number 2, carry out some basic safety checks or make sure that someone else is doing it for you. And number 3, shield your income as far as possible from tax, just as you would shield capital gains from tax too. So, a quick reminder about why diversification matters to income investors as much as someone seeking to build long-term capital gains. Single stocks can be bad for your wealth. Why? Well, there have been plenty of dividend disasters. Now, you can do all the safety checks you like, and I'll mention some in a moment, but occasionally a curveball comes along. Something happens not everyone's expecting. Now, BP was a good example, the Deepwater disaster. They'd increased their dividend payout 15 out of 17 consecutive years prior to that. All of a sudden, bang, dividends halved in 2010. And BP, a significant stock, the biggest stock in the market, the biggest dividend payer in the market around that time. So that hurt if you were overexposed to BP. And certainly anyone in the index at the time, the FTSE 100 index, would have automatically had quite a heavy exposure to a stock like that. General Motors, reliable payer for decades, dividend halved in 2006 and suspended in 2008. Just goes to show that the past is not always a guide to the future. Citigroup, massive financial services brand, one of the biggest at the time, dividend cut in 2008 and then suspended as a function of the credit crisis. Kodak, most people know that rather sorry tale, unfortunately for Kodak. They maintained a fairly spectacular 6.7% yield, 1997 to 2003. That's a decent yield by any standards. Turned out to be what I call a bit of a dividend trap, because underneath it, the engine was running out of gas in the company, if you like. Dividend cut in 2003 and suspended eventually in 2009. And then finally, Tesco, iconic UK retailer, one of the biggest in the world, even they have suffered a fairly recent dividend cut. And how many people would have seen that one coming? A few, but maybe not everyone. So you can't always avoid investing in companies that might suspend or cut dividends. The trick is to spread out your investing. And we'll look at how much you need to spread it in just a moment. Now, the point I'm going to make on the next slide is over the last 30 years, if you get it right, reinvested dividends, so assuming you've got a reasonably diversified portfolio, you don't have to go as wide as the whole index, as I'll mention in a moment. Provided you do that, you can get some pretty decent returns out of getting dividends and reinvesting them. So for example, on a capital-only basis, the FTSE 100 over the last 30 years has risen around 4.75 times, just under 5 times. The FTSE 250, for comparison, has gone up more like 10 times. Factor in total returns, which is where you add dividends in, the idea of reinvesting dividends, and look how those numbers change. It's pretty powerful stuff. 14 times is the gain on the FTSE 100, roughly speaking, and 27 times for the FTSE 250. Now the question then arises, well, in order to try and get some of these reinvested gains, how wide do I have to spread my money? And the answer I deal with in another video, but I'll summarise it here, is you don't need as many stocks in the portfolio as some people think. To achieve a reasonable level of single stock risk minimisation, if you like, so to really cut single stock risk right down, there's low and there's high. A number of stocks around the sort of 15 to 20 mark will do the trick. Now that won't protect you from a market crash, but it will take away some of that sort of dividend disaster potential you get with single stocks. Okay, cover some of that in more detail in other videos. Number 2, carry out some basic safety checks. As an investor looking at a company to pay a stable, regular dividend, make sure you're reasonably certain that it might be able to do that. Now, I'm going to summarise these here. Dividend cover is the number of times that profits before dividend is available to cover the dividend. And you should really look at that on a profit and cash basis. So is there cash generated each year to pay the dividend, and are profits being generated sufficient to cover the dividend? As to the level of dividend cover on a profit basis, I quite like a minimum of 2, then I'm a fairly conservative investor. Some people will live with less than that. But nonetheless, dividend cover is pretty crucial. The higher the better in many ways. Consistency and management's track record. Is this a company that's managed to sustain regular dividend payments, ideally increasing them in line with something sensible like inflation perhaps? But is this a company that's maintained dividend payments over a decent length of time? The past is no guide to the future, but it does help. Balance sheet strength and margin of safety. Now, I deal with balance sheet basics in another video, so I'm not going to do a lot of work on this here, but check the strength of the balance sheet. Check the level of debt being carried relative to equity, for example, known as gearing. Check the current asset versus current liability situation. Check out my balance sheet red flags video for more on that. And try and work out how safe the company is in terms of cover for both recent and forthcoming dividend payments. And beware of high yield traps. It's always tempting in the current environment with interest rates low, inflation low, to go for the big number, to go for that 6.7% yield. There are no free lunches, so you need to be very careful. Maybe you're being bribed to buy stock with a dividend that's ultimately not sustainable or could be at risk. Okay, number 3, shield your income from tax. Fairly quick point, which I cover in other videos, dealing with ISAs and SIPs and so on, but do make sure you're sheltering investments where possible within an ISA and or a SIP, because then the growth achieved on the portfolio, including sort of income received while they're inside those wrappers, can be done free from further income tax. So take any boost that you can get. And something worth discussing, allocate your investments in a way that maximizes the use of other allowances and release. For example, as a married couple, the way you split assets between yourselves in terms of ownership can influence the extent to which you can claim allowances and so on that may reduce your income tax bill on the income that you're earning. So there you have it. 3 relatively snapshot ways to improve your income investing. And if you've got any questions on that relatively brief tour, please send them to usual place.